Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Really excited for today's show. I know I always say that, but I really am. We got multiple guests and good friend of mine, Paul Shannon, on with us today. So, Paul, welcome.
Thanks, Brian. It's good to be back on the show. Nice to see you.
Good to see you too. And more for the people listening than for you, Paul. But I mean, Paul's been on the show many times, a lot of really good episodes. So if you want a lot into his backstory, just search on your podcast and find some of that. But if you can give us like the 30 to 60-second version of your backstory, and then we'll just start talking about what's happening now.
Sure. Yeah, I've been investing in commercial real estate since 2016 as a limited partner.
Mhm.
Got into single family and small multifamily investing actively at about the same time. Started getting some interest in doing syndications as a general partner around 2019. And now we have a multifamily platform that we raise capital for. We operate multifamily properties here in Indiana.
Mhm.
I still invest actively as a limited partner as well to diversify my portfolio by sponsor, geography, asset class, debt maturity, just different strategies. I'm really just interested in the space and appreciate all the benefits that different asset classes within commercial real estate give me. So that's a little bit of my background. I'm a little bit of a hybrid. And through
Yeah.
those experiences, I've gotten pretty involved with the subsidiary of Bigger Pockets called Passive Pockets, which
Yeah.
is the niche of real estate that's focused on real estate private equity and how to become a better limited partner. So
Mhm.
I'm full time in this space and just really have a passion for it and I'm a student of the game.
Awesome. Awesome. Well, thanks for that. Speaking of passive pockets, I know you were a moderator at the Passive Pockets conference. A couple things you talked about, debt funds was one of the panels, and the other one was just like macroeconomics. Let's talk a little bit about macroeconomics right now. What's your take on, what's happening in the country globally and how that affects multifamily?
Sure. Let's rewind till
Hmm.
about January of this year, right?
Yeah.
I felt like there were a lot of caution flags, maybe yellow lights, let's call them,
Hmm.
where multifamily had experienced 12, 18 months prior to that time, expenses that were blowing out your spreadsheet, right? We had tax increases that were very unpredictable. We had insurance costs rising, particularly in places like Texas and Florida, but really across the board,
Hmm.
property insurance all across the country was rising. You had labor, supplies, material costs accelerating. It made for a very rough road to understand, what are my input costs going to be here? How do I underwrite these
Yes.
scenarios 5 years into the future? How do I underwrite a value add deal when this administration is talking about tariffs and every day it seems like there's a flip flop on what was said yesterday? Unpredictability was very high.
Yeah.
And then you had a scenario too where rents were soft, right? We saw that rents,
Hmm.
ballooned out and were growing at a fast pace, 21, 22. Some thought that that would last forever. It certainly did not. And we found
Hmm.
ourselves in a, situation where in many markets supply was a concern. The
Yep.
deliveries were not being absorbed as quickly as units were coming online. That created a scenario where there were a lot of concessions
Hmm.
and rent growth stalled out. Some places it went negative, certain
Yep.
places it held up a little bit better than others. But again, very difficult to predict where things were headed. So looking at it from January 2026 perspective, I was thinking, hey, this is actually a pretty good time to acquire. I think a lot of folks that were in the space maybe 5 years ago are on the sidelines now, or they're dealing with the assets they acquired during those times and trying to
Yes.
keep them afloat. So
You
they're
know,
not
and
actively acquiring.
And looking at what you just said about forecasting into the future, imagine the people that are holding, this is what you were alluding to. People who are holding properties right now are seeing income lines go down and expense lines go up. And like you just said, a lot of them are pausing on acquisitions to focus on managing. So anyway, go ahead.
Correct. So
Yeah.
in my view, it's like, hey, I'm a smaller operator. Now is the time to really push on the accelerator. We've been really, really patient, avoided a lot of the time period where acquisitions were being acquired with floating rate debt and really
Hmm.
aggressive assumptions, et cetera. And we've got an engaged investor group. So that's what we did for almost a year. We acquired 350 units
Nice.
between A, B, and C class. But then obviously the war in Iran came up, right?
Hmm.
And whatever certainty we felt like we had, internally at our group, as far as how we could underwrite, it sort of went up in smoke at that point. It was like, okay, well, this potentially could create a scenario where gasoline, oil prices go up quite a
Hmm.
bit.
Yep.
The Strait of Hormuz is closed. That's where a considerable amount of the world's fertilizer comes from.
Hmm.
Fertilizer is an input to agriculture. So
Yep.
wheat, corn, any grains, any food potentially could be at stake here for
Hmm.
rising costs, which puts downward pressure on pretty much every segment of the population.
Yeah.
And we started to worry about what does that look like? If wages can't keep pace with inflation, how does
Yeah.
that impact our underwriting scenarios? And that was some of the talks that we had at the Passive Pockets conference. Now, whether you believe the war is, the day we're recording this is May 7th. We've got some maybe
Yep.
positive news that the negotiations between Iran and the US and the other parties involved are going relatively well. Maybe this is all for naught. We shouldn't worry about it. But that is one of my concerns as I look at A, B, and C class is like what
Hmm.
class of tenant, what class of property is going to hold up the best in all these uncertain elements swirling around. So I
Yeah.
don't want to suggest that you should necessarily time the market, but I
Hmm.
think the takeaway for me at this last conference was that you want to be more aggressive at certain times when you feel like you have the right tailwinds at your
Yeah.
back, right? At other times, there's strong headwinds that are blowing right in your face. I thought that
Hmm.
that was like 2022, where it's
Yeah.
like, hey, we should just sit down here. Let's wait. Let's see what happens. Let's put our pencils to the side and kind of let this play out a little bit more. And in those scenarios, you should just pencils down and just sit it out, right? So
Yeah.
I think if you look at like a sliding scale of 0 to 100, if the tailwinds are blowing at somewhere between 25 and 75%, you should go, right? And if
Yeah.
you want to play in that kind of standard deviation, if it's at the extreme ends of either end of that,
Hmm.
75 to 100 or 0 to 25, those are the times where it's like either it's too frothy or
Yep.
there's too much uncertainty and you want to kind of sit it out. So where do
Yeah.
I think we are today? I still think it's a pretty decent time to acquire if you have a longer term horizon and you
Hmm.
have investors that understand that the returns that were generated back in the 2018, 2019, 2021 period are not realistic to today's
Yeah.
fundamentals. So if you can really identify the risks, spell them out, and protect the downside, I think it's a decent time to buy.
Yeah, I agree with the properties that I own. We're definitely feels like we're still experiencing headwinds. I think we're at kind of like that inflection point, where the winds are changing. I own a lot of properties in Salt Lake City, and I never thought I would see rents go down in Salt Lake City, but they have, 10 to 15%,
Mhm.
and concessions are crazy. But 2 months ago, we actually started raising rents for the first time in about 2 years. I'm starting to see a little bit of that shift going, to where now we're not having to lower rents to keep people. We're still putting in almost a month of concessions right now, but now it's a month of concessions and we can start gradually bringing our rents up. I think in Salt Lake City, where I focus, we're seeing kind of a little bit of a change from, headwinds to hopefully tailwinds. So, but yeah, I appreciate that. And coincidentally, today's May 7th. You mentioned that. And when you mentioned that, I just, I'm like, that date sounds familiar. May 7th was my very first day on active duty. I showed up to boot
Wow.
camp on May 7th, 2001. But so anniversary for me. But
25-year anniversary today?
25 anniversary, yep. And
Wow.
I completely forgot about it till I heard you say May 7th. I'm like, why does that date sound familiar? But anyway, yeah, the Iran thing, man, I mean, that had a lot of effects on us specifically. We had a property that we were about ready to refinance and numbers looked really good, but lenders got
Mhm.
skittish, and what we saw is, lenders were starting to thaw. They were starting to be a little bit more aggressive with their underwriting. I mean, you're talking about some of the things that, operators look at and, question mark on how to underwrite things. When lenders have question marks on how to underwrite things, they get more conservative and they draw back, right? But
Mhm.
we had a property that we were looking to refinance, and, we went from roughly low $9 million loan, which worked great for us, to low $8 million loan over that 2 week period after the Iran war started. Part of it was fuel costs went up. Yeah, as you mentioned, that affects almost everything, on your expense line. So between the different underwriting standards and, oh, by the way, the 5, 7, 10-year treasuries, which these loans are based on, also went up 30 to 50 basis points,
Right.
depending on what day you look at them as a start point. But that little Iran war, which I'm with you. I hope it ends soon, but that had a much larger effect, on very short-term stuff than I would have imagined. But
Yeah,
yeah,
unquestionably. And you make a great point there. I mean, that's something I didn't mention about
yeah,
acquisitions that are in the pipeline start to look a lot different when the 10-year jumps from right around 4% up to
yeah.
435 or 440, and
Hmm.
deals that pencil before don't anymore. And we
Yeah.
had a similar situation where we were in LOI and we're negotiating the PSA, and that broke out. And we
Hmm.
started to see the seller drag their feet, and eventually it was became a short sale back to the bank. And
Hmm.
the bank, I don't know if they didn't want to pay the commission to the broker, which we had found the deal through, or
Hmm.
what, but they wouldn't engage with us, and they may have taken the property back to save the commission. I don't know what they did, but we ended up not getting that deal. But we were at a point where we were like, I don't think we want it anymore. It doesn't look the same on paper as it did a month before. It seems like a lot of stuff happens. Transactions can happen at about 4% when the 10 years floating around that number.
Yeah.
Stuff starts to open up. And when it floats up considerably from there, transaction volume just dies off. And we've seen our pipeline really significantly fall. If you're a seller, you're thinking, unless I'm forced and I have to sell, if I got a
Yeah.
maturity date coming up or whatever the case may be, there's a personal situation with the partners or whatever, why would you
Hmm.
sell, right? So people just don't end up putting their properties on the market and everything kind of shuts down. So anything that is listed too, I still feel like there's enough buyers on the sidelines where you get a lot of
Hmm.
competition for the slim pickings that you have. So it's an interesting dynamic now. Very, very
It
interesting market
is.
that's very fluid.
That changed for us, when we went from, a $9 million in proceed to an $8 million in proceed. That's the difference between let's refinance and carry and or do we really want to put, a bunch of money into this one to keep it going? So it was, kind of a game changer for us, just that timing right there. There's one property we have that we'll be selling right now because that refinance didn't work out. Now, of course, if the war ends and the treasuries come back down and gas prices come back down, we still have a little window to try to make it work. And then to your point, we've got two other properties with early fall maturity dates that are only on the market right now because we have maturity dates coming up. And
Mm,
so you're absolutely right. If you don't have a really good reason to sell right now, why would you?
hmm.
And that's kind of what we're seeing on the buy side as well. There's just not a lot of stuff sitting on the market because it's not a great time to sell, which means it is a great time to buy, probably.
I agree.
Yeah. Looking forward, what does your crystal ball say? You were talking about, headwinds, tailwinds, and not just multifamily. I know you're involved in other asset classes as well. What are you looking into the future? What are you excited about as far as investments go right now?
Good question. The crystal ball is certainly foggy. I've been predicting that we'd have a recession since like 2022. I think I gave like a webinar presentation to a group of
Hmm.
investors, how to weather a recession with your portfolio. And I guess I was right that there was
Yeah.
going to be a recession in commercial real estate, but the broader economy has been just absolutely humming along here. So the
Yeah.
S&P today is at an all-time high, but what goes up must come down. And we know that this investing world is a cyclical space and there will be a recession at some point. I thought that, what I said before about fuel costs going up and that
Hmm.
impacting agricultural and food eventually in the grocery store would potentially put like, a lot of downward pressure on the consumer. And I think
Yeah.
eventually we may see that. There's segments of the economy that are doing really well, like tech, but Main Street
Hmm.
businesses, I don't know. Maybe we'll see that this can be held off for a lot longer than I initially predicted in 2022. That
Yeah.
the economy is so distorted right now because of all the money that's flooded into the system to keep it afloat. It's unprecedented.
Yes.
We doubled M2 money supply back in the COVID days, and I don't know if
Hmm.
that effect has really truly played out yet. So what I
Hmm.
do know is that we've got $40 trillion in federal national debt, right? And that
Yes.
number continues to go up. It seems as if the administration is, more concerned about keeping the stock market elevated than it is about, operating a balanced budget. So that's one data point to consider. And
That's one thing that I'm most concerned about. If you kind of look at what's happening globally, a lot of countries are divesting out of the U.S. bonds. There's a
mhm,
lot of countries that have U.S. bonds, and we've seen gold go from 3,000 an ounce. I haven't checked it in a week or two, but
4,700 today.
4,700. Okay.
Yeah.
It hit 5,000 for a brief period, but most of that's occurring because other country treasuries are divesting dollar and investing in gold instead. So that's something that, what's happening in Washington is really affecting the global markets and it's going to have an effect on us too.
Yeah, nobody knows, but I
Yeah.
think if you study history, you study financial history, you can kind of see that these types of things work themselves out in massive long-term cycles, right? Ray Dalio wrote a book recently on the changing world order and talks about how money is tendered and how
Hmm.
gold has always been for 2,000 years kind of the the fallback when fiat currency falters. And I think we see remnants of history in today's world and what's happening with our
Mhm.
currency. We still have the reserve currency of the world, but if we ever lose that, our standard of living as a country will be impacted. But what I'm doing to hedge that scenario and what I believe is that none of us own enough hard assets. And I include real estate in that
Yeah.
argument. So I'm trying to find inflation protection and hedge against inflation
Mhm.
by buying tangible real assets that in most cases produce income, like real estate.
Mhm.
But outside of real estate, I'm investing in gold, silver. I've invested in agricultural commodities. So I think those types of assets are really interesting in today's world and are sort of a beta against, the stock market and what happens there. I'm still invested in public
Mhm.
markets. I'm not one of those people that mistrusts the market. I take it for what it is.
Yeah.
It's somewhat gambling. There's people that are shorting it. There's a bid and the ask. There's a buyer and a seller on each side, and you got to pick your side. And sometimes you're going to win, sometimes you're going to lose. If you're a long-term holder, you're probably going to make out and get the average. I think there's a case to be made for diversification across public markets and private markets, and in private markets and real estate syndications and that part of private markets, there's a case to be made to diversify amongst different real estate asset classes with different sponsors. And
Mhm.
so it's really about just spreading out the bets and making sure that I'm not super hyper concentrated in one specific deal or one specific market or one
Yeah.
specific asset class where, I just want to stay in the game. I know I'm going
Yeah.
to take some losses and I'm probably not going to have as big of wins because I'm not taking that hyper concentrated bet where it could go really well. But I'm also not going to have those really big losses either. And I just kind of want that steady linear path of net worth to accumulate over time and
Yeah.
be able to stay in the game. So,
Yeah, you make a really good point, and one that resonated with me. Going into this multifamily downward cycle that we hit 2022, I was hyper concentrated in commercial real estate. And my goal was to, start diversifying at the time, but I think I did too little too late, and so I took a big hit just because, multifamily took a big hit. But now I'm diversifying as well, and it's something that the other thing that, and this is one of the not so great things about commercial real estate, is the lack of liquidity. Those were the two big pinch points I've had, being hyper concentrated into one area. But yeah, going forward, I've already made a couple of rules for myself. Since I am, a multifamily guy, I'm lead sponsoring deals and I'm investing in everything that I'm doing. One of my rules is that's the only multifamily I'm investing in. Whereas a couple of years ago, I was putting money with other operators when I had it and letting it ride. But yeah, that's my goal over the next couple of years is to restart diversifying again. I think I went
hmm
from fairly diversified but small portfolio to a very hyper concentrated portfolio, and now I want to get back to more diversity. And speaking of, you mentioned gold and silver. That's one thing that I've always loved. You might not, let's see, get this in the light.
it's
I've
too
always
shiny.
collected silver coins,
Oh, cool.
and I've got a couple within arm's reach of where I'm sitting right now. But I've got several $1,000s worth of silver, but that doesn't move the needle much. That's like collection. But that's one thing that I've been ramping up right now on too, even though silver's, both all the precious metals have taken a hike right now. Ramping up on collecting things like that as well. So
Those are hard assets.
yeah.
You mentioned something about liquidity that I think is interesting because it came
Mhm.
up at the Passive Pockets conference I was just at,
Yeah.
and how when the syndication world took off and people had somewhat of a shiny object syndrome, they were
Hmm.
looking to allocate, right? And they put all their money into all these deals that are illiquid, and then they realized that there was a big opportunity cost to that. Or maybe
Hmm.
they, don't have the reserves that they thought they did. They have capital calls in their portfolio, or they've had principal loss and they don't have the same liquidity as they might if they were in public markets or had access to line of credits or those
Hmm.
types of things. So, or had somewhat more liquid positions like debt funds where you can redeem
Yeah.
out theoretically and get your principal out and rotate into something more aggressive. So I've been looking at that more carefully lately too.
Hmm.
Just making sure that I have either cash equivalents, or access to cash in some way
Yeah.
for either opportunity costs or the rainy day that I don't see coming because
Hmm.
we're all prone to mistakes. We all make assumptions when we make these investments and they don't always go as planned. So having something to fall back on is reassuring, and having a portion of your portfolio be almost an insurance policy, I think is a safe way to play it. But that's come up a lot lately in my circles with LPs and just, investors in general, that
Mhm.
liquidity is far more important. You don't realize how important it is until you don't have it and you need
Until you
it.
don't have it. Right. Yeah. And I mean, I started, very liquid with a good chunk of reserves, but I have two employees and several properties that have had capital calls. And so when you have a couple of years where multifamily is not doing great and you're hyper concentrated in multifamily, there was a slow burn on that. And I've learned a lot from this. And I think, looking back 3, 4 years ago, I thought, hey, everything's roses. This is awesome. And now I'm going back to what I should have been doing from the beginning. Sometimes conventional wisdom, diversification, sometimes that actually makes sense,
Yeah.
right? So
Well, Warren Buffett doesn't think it does. Doesn't he say that diversification is just for people who don't know what they're talking about? I'm like, well, that's me, I guess, because I'm not willing to, to have that kind of conviction, that's for sure.
true, true. He's made a lot of quotes. Something that I attribute to him that may not have been him is you build wealth through concentration
Hmm.
and you maintain wealth through diversification, right? I think he said something about along those lines.
Paraphrase along those lines, yeah.
Yeah, but he's been hyper concentrated. His model has been the same for, 50 or 60 years. He buys businesses with strong fundamentals that are, happen to be at a really good price. And he's also said his favorite hold periods forever. A lot of those things translate really well to multifamily, but a lot of lessons learned when things go out. Now, another favorite quote of mine from him is when the tide goes out, you find out who's swimming naked. And I think that's been very apparent here recently too. So.
Yes, indeed.
Yeah, but so mention a couple of properties you bought or partnered with people on in the last year or so. A class, B class, C class. Tell us a little bit about those, why you like those properties. Tell us what that looks like right now.
Sure. Yeah, I'll try to give you the cliff notes as to what we were attracted to and then, some of the different challenges we face within each property. So the A-class properties outside of Louisville, Kentucky, 2023 vintage,
Okay.
183 units. The plan going in was we can get this at a discount to replacement cost. It has strong fundamentals and in-place cash flow. We had positive leverage, which was a term that you couldn't use for a couple of years. We thought that with the tariff situation happening, this is May of last year, 2025, the tariffs and the uncertainty around that, we didn't
Hmm.
really had to worry so much about labor and materials and input costs because it wasn't a value add project. It was already there, right? But the risk was that there was a lot of deliveries in the market
Yeah.
and we were going to have to fight with competing properties on qualified tenants. So there was a lot of concessions and we saw that right out of the gate and we
Yeah.
lost some occupancy. The prior owner had put tenants in that weren't necessarily as qualified just to get the occupancy up for the sale, which we anticipated to some degree, but
Hmm.
we didn't really know what kind of arena we were stepping into, I guess, from a
Yeah.
competitive standpoint. And it was a battle. We just got up to 95% occupancy very, very recently
Good.
this year.
Good. Good.
We're off pro forma, by 10
Hmm.
or 15% because of concessions, frankly.
Hmm.
Operating costs have been held in check really, really well and are what
Yeah.
we anticipated. But it's been the top line that's been a bit of a challenge to get
Yeah.
going. So,
Concessions, man. I saw a report on Salt Lake City and average concessions were 18%. No,
wow.
nobody underwrites, 18% on concessions, but the
Wow.
last year average concessions, 18%. And granted, it's the brand new stuff that's kind of, skewing the numbers. Yeah, the concessions, man, they're big everywhere. So,
But
um,
with that property, what's interesting is that
mhm,
the rent to income ratio in the area based
yeah.
on AMI is pretty low. So
Yes.
there's affordability to push rents a little bit farther. Now that
Mhm.
we've seen some of the units absorbed with the competitive set, I think it's about time. You mentioned you started to raise rents in Salt Lake City for the first time in
Yeah.
a couple of years. We're, I think, almost there where we can start to
Yeah.
drive that needle again. We have to be because we're going into year two on a
Hmm.
5-year business plan, and we're going to have to figure something out. So that's been the challenge of that property. So that's the A class.
Hmm.
B class was a different story. 90s build, no real value add to speak of. The operator was a retail like strip center operator, and they got caught up in the multifamily mania and bought a few properties, I think 6 or 7. This was their farthest property from home in Indiana. They were out of Georgia, and they
Hmm.
just decided it's time to go. It's time to cut
Yeah.
bait. Property was 98% occupied, no new supply in the market, steady rents, not a lot of opportunity to push rents higher based on
Hmm.
the income situation, but without many other choices from a tenant perspective as to where they could live. And this being probably one of the nicest communities and well-maintained
Yeah.
communities in the area, we liked it as sort of a coupon clipper. It was going to be
Hmm.
a cash flow play, not a huge IRR, but we just go in, we take care of some of the
Consistent.
maintenance and keep it consistent and run it really
Yeah.
well.
Without a value add, I scratch my head. I'm looking for 90s value add opportunities. Was it recently renovated or just very well maintained?
It's very well maintained. It has not been recently renovated. Probably about 15 years ago, there were some updates done. But the thing is that we found in some of these markets in our local area is you can go in and you can put a new kitchen in,
Mhm.
cabinets, counters. You can put a vanity in the bathroom. You can upgrade the flooring and give it fresh, modern, agreeable gray paint. And tenants don't care. They might like it, but they're not willing to pay an extra even $50 for it. So if you talk about doing an 8 to 10,000 renovation, you need to get higher rents than $50
Yeah.
to make it make sense, and it just doesn't. So we can keep heads in the beds at a lower price point, keep it affordable for the market, and not spend that money and just operate better and try to focus more on the expenses, the
Hmm.
living experience for the tenant, and retention.
Yeah.
So it's more about operating than it is about pushing some business plan renovations and such. So
Yeah.
that's been the plan there, and it's relatively fresh on the books, so we don't have a long runway to see like what this will look like a year out from now. But we're exceeding
Hmm.
pro forma on that deal after year
Good.
one or after quarter one. So that's the B class. That's pretty right down the
Hmm.
fairway. And then we've got a C class property. This one's
Hmm.
a little bit smaller, 56 units. This one was somewhat of a distress scenario. So the seller
Hmm.
was out of the West Coast. They bought in Indiana 5 or so years ago. They had a maturity coming up.
Hmm.
They bought at, a basis that wasn't realistic for what today's stuff is trading at.
Yeah.
And they let it go a little bit. There was some deferred maintenance. It was pretty well occupied, about 85%. So we just reset the basis and
Hmm.
reset the debt. And we got good terms. We bought it for basically what they had as an unpaid principal balance left on the deal. We financed it through a local credit union
Okay.
that we've worked with plenty of times in the past, and it being a smaller deal at 56 units, it wasn't agency ready. We may eventually refinance into agency at some point, but
Hmm.
it was perfect for a local banking relationship. And
Hmm.
we've just gone in and we've cleaned up a lot of the deferred maintenance that's been sitting around for the
Yeah.
last 2 years. We had some non-paying tenants we're still working through workouts with some of those folks. Some folks are, deciding to leave or have to leave. And, we're finding that in that market, that's Evansville, Indiana,
Hmm.
rents about 18 months ago are what we're getting now again today after seeing a
Okay.
dip of about, let's call it 8 to 10% during that 18-month period. So we're back on track. We're, spending a lot right now, but I think we're going to start to see our P&L smooth out. I guess my concern with that property is that we're pushing the affordability ceiling.
Yeah.
They're all two-bedroom units, and there's a fair bit of two-bedroom units that are vacant right now. And I think given the opportunity, some tenants are taking a one-bedroom instead of a two-bedroom to save the roughly two to three
Hmm.
hundred dollar difference in rent.
Yeah.
So, what we talked about before about gasoline prices and food prices and inflation picking back up, I think that's definitely the most sensitive group out of any of the three aforementioned
Hmm.
asset classes that we're going to have to keep our eye on because
Yeah.
that's the group that you're going to start to see economic vacancy rise, not just physical vacancy with
Mhm.
nobody living in the unit, but tenants that aren't making payments, that can't afford to make payments. I read a post by Jay Parsons recently that highlighted that there's, these A-class tenants, there's, like I mentioned about our property near Louisville, they've still got some
Yeah.
opportunity to pay more rent to get to that kind of 30% of income goes towards
Hmm.
rent ceiling, where it starts to become less and less affordable. Some of these C-class tenants around the company Jay cited are paying 80% of their income
Wow.
towards rent before even factoring in utilities, et cetera, et cetera. That's not happening in my market, but I thought
Yeah.
that was an astounding figure because obviously that's not
Man.
sustainable and they have very little left over for food or anything. So I think the affordability gap continues to grow, the wealth gap in this country between the haves and the have-nots.
Yeah.
And that's really something, I think we've known for quite some time, and
Hmm.
multiple administrations have kicked the can down the road or tried ineffective methods to fix. That is something that we really need to figure out here because
Yeah.
it makes no sense, an underwriting standpoint, to build C class today unless you're getting significant grants and city money, ready money, almost for A class too in some markets. So,
And the problem with the grants that you get is they come with strings attached.
mhm.
And sometimes the strings attached, I've looked at several properties that were built with these strings attached. And when I start looking into what it takes to actually manage them, it's like, I don't want to deal with that. But yeah, there's a lot of great points to unpack there. Fuel prices go up from, I think we were paying 280, 260 at the pump, and now we're at like 430 where we're at. So we've gone up, a buck 50 in gas prices here. A lot of the C-class tenants have very thin margins, and that's just very indicative of that C class, where they're sitting right now. And so there is a significant effect of rising gas prices. We've got one property right now with several open two bedrooms because people don't want to pay that two-bedroom premium. And it's exactly what you said, it's resonating. It's like, yeah, we see that happening right now where they are getting pinched. And so, there's lots of things that are pointing towards, multifamily taking off, but the economic issues, a lot of things that are happening, I think in Washington are affecting, negatively affecting what we're doing right now, the tariffs, all that stuff negatively affecting, it's affecting prices, it's affecting inflation, it's affecting the pocketbooks, and now people can't pay as much for rent, which I think, yeah, you hit the nail on the head there.
It's affecting value add business plans too. If you're an
Mhm.
apartment operator, I read that tariffs have created roughly a 6% increase on kitchen cost inputs.
Mhm.
So we're talking about on the aggregate, if you take cabinets, countertops, appliances, everything that goes into remodeling a kitchen,
Yeah.
it costs now 6% more than it did last year, due specifically to the tariffs. So
Yeah.
those input costs, if you're going to take that business plan approach, you ultimately are passing that on to the next tenant. And if they can't
Mhm.
afford it, that business plan doesn't work anymore. We have seen that most value add business plans don't work over the
Mhm.
last few years, but I've heard the term we're in a decaf stagflationary environment. So this is
Mhm.
where it's not quite, full on panic mode yet, but it seems as if growth and wages are sort of faltering slightly potentially, and costs are going up significantly. And if that
Yeah.
extends out that trend into the future for quite some time, that's not the best economic environment to be operating in. So we'll have to be careful.
Yeah. Yeah. You mentioned the cost going up. It goes back, if you're in acquisitions mode, you can't use last year's cost models either. We did a renovation. We purchased a value add just over a year ago, and we are renovating our last unit right now. And our general contractor, I mean, every general contractor puts a little bit of fluff in the numbers. And they told us, hey, we've been able to hold these, we've been able to hold these. And obviously a big disclaimer up front, hey, if prices go up, we're going to have to change some things here, but they've been able to hold firm. But if we were to do that same renovation today, we couldn't use the exact same numbers. And so, yeah, going forward, there still are a lot of question marks, on a lot of things with the underwriting, a lot of things with the acquisitions. I'd much rather have a clear path forward, but now there's a lot of navigation that's happening, a lot of being a little bit more selective with assets. Let me ask you one question, and then we probably ought to start wrapping up. You
Mhm.
mentioned A class, B class, C class. You purchased one of each recently. If you had to pick one to hang your hat on for the next couple of years, where would that be?
I would probably pick B. I think
Okay.
that's right in the middle, right down the fairway is the analogy I used before.
Mhm.
Some of the stresses, the income rent to income ratio issues that the C class space has, and the deferred maintenance and just the older property
Yeah.
problems. I think unless you can find something that's really distressed, where you've
Hmm.
got a basis that you can reset, or you've got significant upside in rents because it hasn't been touched in 30, 40 years, it's just not as attractive of a proposition today. A class, I'd say in general, it just depends on where you're located in the country.
Hmm.
Austin is still seeing a lot of supply that's being
Yeah.
worked through, and it's very difficult there to. You're certainly not going to be able to push rents in Austin. It seems like
Hmm.
maybe it's trough, but rents have come down considerably and they're not going up
Yeah.
right now. And there's other markets that are like that out there. So that'll eventually work itself out. Some of the pressures that you talked about, contractors being able to hold pricing, and a lot of them haven't been able to hold pricing, especially on new
Right.
bids. And, these new development projects just don't pencil at all. So there's a lot less coming out of the ground today. And
Hmm.
you've heard the headlines like
Yeah.
the supply has been in excess, but with no new stuff coming up, unless somebody's got a real competitive edge as a developer to put
Hmm.
product out right now, there's just a lot less. So
Yeah.
eventually that's going to, I think, benefit existing owners. But I think A class still, because of the affordability difference between
Hmm.
The haves and the have-nots. The haves still have some room to pay more for rents in some of these markets. I think it's just very market dependent. So A class could be the answer to your question depending on where you are. But I think
Hmm.
where I am, I think B class makes a ton of sense because
Yeah.
they're tenants that the retention is a little bit better. They have
Hmm.
solid jobs. Some of them have jobs that aren't as susceptible to being replaced by AI, for
Hmm.
example, as maybe even A-class tenants, the white collar workforce. Some of these are, HVAC technicians or whoever, right? I mean, and some of those jobs are irreplaceable by AI, at least in today's standards.
Yeah.
So we have humanoid
Yeah.
robots running around. But I think that B class, just like when you're in a recession, B class tends to do pretty
Mhm.
well overall relative to other asset or property class types. I think B class is a solid play right now.
Yeah. And I tend to agree. I mean, I'm just generalizing, I've owned a lot of C class in my life, and
Mhm.
you mentioned older properties tend to have problems. There's one property right now where we've got a backhoe that's, digging up next to the foundation because we have, a couple of leaks coming into certain units that's causing lots of problems. That's a lot more common. This is actually a 60s build property, so it's older than I am, but there's a lot of things your C class properties have C class problems is how I
Mhm.
always phrase it. And C class tenants have C class problems. The B class properties that I've owned, when people leave, it's normally because they're buying homes,
Mhm.
right? And if they're able to buy homes, they're much better off economically than your average C-class tenant. The way I look at it is your average C-class tenant is a renter by necessity, and your average A-class tenant is a renter by choice and lifestyle, right? It's kind of how I look at things. But yeah, I think there's a lot of goodness for B class. We're just shifting our buy box. If we're buying C class, we want it to be top of the market C class, where with a little bit of polish, we can maybe move it from a C plus to a B minus. But yeah, there's a lot of goodness there. But I think in Salt Lake City, we're kind of moving into a B class light value add type, buy box right now for much of the same reasons. So.
Yep.
But you are absolutely right. It is very location dependent. We're dealing with similar issues as Austin, just not to that extreme. A lot of A class being built, which has depressed a lot of the market. But you mentioned the future, multifamily under construction. I think it was from a Jay Parsons post, but I literally had that graphic up on my screen when we started. But you can see a downward trend from the peak. I think the peak, well, looking at the graph, the peak was mid 2023 of apartments under construction. But, to your point, a lot of the headwinds for multifamily operators, the people that buy existing like me, are also exist for the people who are developing. They're
Mhm.
dealing with the high interest rates, they're dealing with, price uncertainties, and so that's going to affect, the properties that are going to be delivered in the next 2 to 3 years. So, yeah. Anyway,
Well, all
well,
that said, I think that,
yeah.
every property has a
Hmm.
clearing price where it becomes a good deal in any
Yeah.
market, no matter what's
True.
going on. So it's about relationships, patience, finding
Hmm.
inefficient markets, having an unfair advantage. All those things can trump any of the other data that you see on a macro level.
Oh, yeah.
So got to keep at it.
That reminds me, I went to a conference about a month and a half ago. I kind of have a policy if people ask me to speak at a conference, I go, right? And so one of these conferences tied to a coaching program asked me to speak, and so I went. And some of the guys there were asking about, 10-minute underwriting tools. They were asking me, what do I do on a very first pass to see if a property is a good deal? My answer was, it has nothing to do with the numbers. I look at the property, I look at where it's at, and I ask myself, do I want to own this property?
Mhm.
And then I underwrite it to figure out at what price does this property work for me and
Mhm.
for my investments. And so I like how you said that there's several of the coaching programs that have these, back of the napkin analyzers or a 10-minute analysis tool. I've never really bought into that, but everything works at a certain price. Almost everything works at a certain price. And, if you can find something that works at a price that a seller's willing to let go of a property at, boom, there you go.
There you go.
Anyway, I got lunch with a buddy here soon, so I'm going to have to call it quits now. But Paul, thanks for coming on the show. Very much appreciate your time. One last question, and that's how can listeners learn more about you?
Yeah, I appreciate it, Brian. It's good
Yeah.
to to be back on with you. Good to see you. Thanks for having me today. You can find me at investwisecollective.com. That's my company.
Mhm.
And then put out a lot of content on LinkedIn, and I'm in the archives quite a bit at passivepockets.com and on the Passive Pockets podcast.
Awesome. Awesome. Well, hey, thanks a lot. Appreciate your time. And for those listening, the links that he just mentioned, they're all going to be in the show notes. So click the link. You gotta follow him at least on LinkedIn. He's got some of the most insightful posts I see in a given, period of time. So definitely follow Paul on LinkedIn. And anyway, Paul, once again, thanks a lot. Good to see you again.
Thanks, brother.